Good morning, folks. November the 1st. Sorry about yesterday's lack of video. I had a spot of man flu, so sounded terrible. I'm still a bit sniffly this morning, but I thought I'd just do as a quick recap to what's happening. As you can see, it's like crude's broken down through the what was a 4-point bounce and broken through now. It's quite interesting is that we're not really seeing the increase in, hold on if I move to the correct chart, we're not really seeing the increase yet in any historical or realized volatility. You can see here 7-day, 2-day, nothing. It's been a real slow move down. But what is quite interesting is, if I bring up this is implied volatility of the front month. We are seeing a front month spiky vol now. We're still only down at the kind of June lows and August lows, where there's a lot of lows that were formed in swings around here, but volatility's just ticked up a little bit. It's kind of a bit concerning if you're short vol, but what's the rolling 3-month contracts, the rolling 30 days looks, if I bring it over here as well, looks to be ticking up as well as the underlying price comes down. So this is a normalized 30-day, because you'll happen, the front month gets very bouncy as time runs out. So we've got like kind of 5 or 10 days left in this. It's about as much use as a chocolate teapot. But the rolling 30 it normalizes that, and I'm not sure if this will put both up as well. And I put the 60, and there you go. You can see 60's up as well. So it's a genuine lift in vol that we're seeing here. So if we take a quick look at the overall surface, so remember this is the at the money vol for the first 10 months, or 12 months I believe this is. So you can see the front months are going to be the highest at 27, and then if you remember a few days ago we did have a weird kind of space where we were spiked up here for the January. The lack of days running in this, which is probably like 12 days I think, 13 days. So it's going to be very bouncy. But we have obviously if you look at the rest of the term just down here, in the kind of 26.5% zone, this is kind of, we are talking about, small differences, but large trades across a large distance. This is a lot of variance. So I mentioned before that this was the peak month because of the OPEC meeting. It was where the OPEC sat into that. So you would be, off the top of my head, early December OPEC meeting. And then you'd be OPEXing out about the 15th, 16th of December. There you go, 14th. So you've got 10 days of play here, so they're pricing that. And then the lull down here is just the Christmas period. So it's an interesting angle, that is, of kind of selling here and buying here volatility, because you do tend to find that early January is usually quite an active period. But overall, as an average, somebody with a pretty good model would have worked out they can sell everything into December, late December, and have done as well. And then we just level out. So that's what the term structure looks like at the moment. Still pricing in a bit of a wild ride around OPEC. So what I've got here is this chart is vol skew percentage by strike. It's actually a lot easier than it just sounded. So you've got here, let's take a look at the yellow line. It was the 23rd of October, and you can see if you got rid of the and drew this as a line, it basically does the kind of traditional vol path. And then you've got the 30th, which is the lighter green. And then you've got the rolling 60 days, rolling 30 days, and the blue one is January. Clearly, we've moved down, so we're moving all the time. So whilst this is kind of nice to see, it just strike by side, it's kind of a bit useless. So what I'll do is load it as skew by delta. So keeping a consistent delta, what's the value? So some interesting things that have kind of come out is you could look at the 23rd when we were considerably higher in crude, over $4 higher. Just having a quick look, you'll see that the puts were a lot further bid, and they've actually been, even though we've come lower, they've been sold down. So the equivalent 20 delta puts and the equivalent 10s have been sold off, and you'll see as well as that as you're falling, you're going to have to see a higher bid on the call sides as well. And it looks the belly has got a lot less steep as well. So you're obviously down here, and we've come back in. So this is a comparison of a true. Obviously, these options are only, you know, a 30 delta option for the moment in time that price is there, but it's a good comparison to find out, you know, what the skew looks like. And this is skew percentage. Where the previous chart was volatility, this is skew percentage. So you're actually looking at what that looks like as a variance. So a 5 delta put is 25% more expensive than the associated call. We'll have a quick look at vol as it decides to load. There we go. Sorry about that. And this is the you know, you would be looking at some of the videos I've done as what this skew by strike looks like. So skew by delta looks like. Apologies. So you can see here is that, you know, we're seeing generally puts are becoming a lot more desirable. That's I think I've used this term before, is if you're looking at that boat that's in the ocean right now, we're certainly being hit by a big wave and we're tipping right over. And this is I've seen it more extreme. I've even seen kind of, you know, the delta line looked pretty much like this before, but we're starting to find to levels where people will be happy to push, and you can see there's a little bit of a dent here where people are happy to push into that. So this chart here is just showing the 20 delta risk reversal for January and March over the last 5 days. It's a rolling chart. I've showed you this before. You know, it looks kind of like that usually, but you can see here the risk reversal of puts favouring over. It's quite considerably dropped towards the latter part of last night, and again the first readings coming in today are showing that are still accepted values. So there's certainly some concerns that there's some more put demand. Usually, I mean, you know, a 5-6%. If we look, if you give me a second, I shall bring this up. So this is the 1 year's worth of 20 delta risk reversals. So, you know, 6% is the max we've had in a year. A couple of times dipped down. Was that 5.5, 5, 4? Yeah, so we're looking at 3.3. You know, 3.3 here, but the risk reversal in the March is a lot more aggressive. I think there's a lot more concern with oversupply into that quarter. But you can see that, you know, we're now at levels where people would certainly be happy to buy the risk reversal. So we're just going to jump over now to looking at, because a couple of people have said to me, how do you calculate standard deviation moves for options? And more importantly, for the guys looking at the day-to-day standard deviation moves. Quick Strike kind of got something already done. Nick's going to make some changes, so this is a bit more user-friendly. But what you've got here is this. This is looking at the. It doesn't really matter what options comes up. This is just the front month option. It's not a problem because we're going to make changes to pull out the standard deviations of the day that we need anyway. So if I just bring over the chart that we can edit. So you look at whatever the front month is. That's what you want to put in here is the settlement price. So we settled last night at 65.31, and we then input volatility settlements, which was 28.3. Well, I think it's 28.22, but it's thereabouts. And then the final thing is you're actually looking at what a standard deviation is on a day. Even though this option's only got 13 days left, you get rid of it all. And let me just boot that back up. Okay. So everyone can see it on the screen now. You can see. So from settle, one standard deviation on the day, we've got 96 ticks. So from settle of 65.31 minus 96 ticks, so down at 64.35 based on that bowl is one standard deviation on the day. Or people, the old school way of calling it was break even. You know, if you'd have bought vol bought straddles overnight, you needed them to move, 96 ticks in either direction for you to start to get break even. 2 standard deviations of 191. There's a load of theories about all of this stuff where people will say, right, it needs to be updated all the time because vol might nick up 2 ticks or down. Rather than just going absolutely crazily nuts about the whole thing, I just take the settlement price, which is all that matters to any options trader, and the volatility of the front month. To be honest with you, it can be any month because you're just going to move the dates anyway. Volatility of the front month, and remove everything down to one day, and that gives you what standard deviation of that day looks like. So you'll probably find that there'll be some value buyers at 64.35, on the upside 66.27. And because a lot of people kind of say to me, well, how do you know what people are going to be hedging there? Well, everybody's mark to market at the settle. It's the only number that matters. And they'll be looking at managing risk around that point because this is a risk management game. It's not buying or selling and fingers crossed. People are simply managing their risk accordingly. So there'll be demand down there. And there'll be willing sellers up there. It's the same reason that if you're a distance away from the settlement price, that so often we end up, and I'll just show you on a chart here. Just hold on 1 second. You'll have to excuse this chart. It's got a lot on it because I pull out some of the quota looks at some different things that are going on. But this yellow line is all we're looking at the moment, which is the settlement. And you can see, there's, why is the settlement creating buyers here? Why is it then creating, the settlement is the number that everybody's marked to. And especially on the last day of the month. No one wants to risk their shirt. So anybody sitting long that gamma is looking to try and dump it out. Anybody short that gamma is just, is looking to protect themselves. And, you often will find, we're rallying up a little bit now. And, we're only 31 ticks away from the settle. We're coming in to the US session. There's no pit open anymore, so it doesn't. That whole kind of 2 o'clock UK time, 9 a.m. New York time is kind of null and void. But you do find that there's a few more US only market makers that refuse to quote outside of the hours. They've started quoting always at 8 a.m. so they'll already quote in New York time for half an hour. That's why you see the liquidity injection. But, I wouldn't be surprised to see, some natural selling up at that 35, that 65.31 level. And, that's that, especially when you've moved away from the level. And it's not for anything else, but it's just, time of day hedges, which are just looking at managing the amount of theta they've got burning away or collecting, and when you get movements,